This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 385. Private equity funds, capitalists or leeches?
But we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that they're not calculated in a manner that I would regard as honest. And so if I were running a pension fund, I would be very careful about what was being offered to me.
This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
So Warren Buffett is not a big fan of private equity firms, in particular the way they borrow so much against the assets that they are borrowing. He thinks they don't provide a good return for investors. Well, for the people who worked in Morrisons, they might think that it's not good for the companies that they're buying either. So what are they good for? Well, equity funds are good for the owners of equity funds, but is that it? Are they an under-regulated part of the finance sector that has had it too good for too long, leaving a trail of destruction in their wake? That's what we look at this week on the Debunking Economics Podcast with Steve Keen. I'm Phil Dobbie. Welcome along. Well, let me tell you about Morrisons, the supermarket chain. Actually, it's one of Britain's biggest supermarket chains. It's 124 years old. It was founded in Bradford by William Morrison in 1899, and it was all going well. It was passed down through the family, with Ken Morrison taking charge in 1950. He was actually working for the company from when he was just 5 years old, helping to stack shelves and the like. So it grew up mainly in the north of England. They were quite innovative. They introduced the first self-service checkout in 1962. In 1967, it listed on the London Stock Exchange. In 1999, they celebrated 100 years with the opening of their 100th store. And they were one of the first supermarkets really to try and create the feel of a series of smaller stalls and small shops within one big supermarket through having different, deli counters and all that sort of stuff. The other thing they did was they maintained the same price from store to store, whereas all the other supermarkets were charging different prices depending on the wealth of the area. It didn't matter where you lived with Morrisons. It was the same everywhere. So all was going well. It was making healthy profits. When Sir Ken Morrison bowed out in 2012, it was making a profit of £612 million, which is about 840 million in today's money. Shares had skyrocketed to £325. Go back to 1985, they were worth about 10. But then things changed. They bought, now out of the hands of the family, they bought Safeways for about £3 billion in 2004, another supermarket chain. It didn't go well. Shares went down to £160, making them ripe for takeover. That took a while, but in 2021, shareholders agreed to sell out to a US private equity fund, Clayton, Dubilier and Rice, for £7 billion. The problem is the private equity fund borrowed the money to fund the purchase, and using obviously the equity of the business to support that loan, and they were caught out by interest rates. Think of the timing. This is 2021. So presumably it had all been written into the balance sheet of the business. So now, Steve, they are making cuts. Morrisons is struggling. I mean, it's a travesty. How could this sort of thing be allowed to happen?
Well, it happens all the time, and like a lot of these private equity firms actually work on quite rapacious terms. They will, as you say, borrow the money to do a takeover. They asset strip the company in the meantime. They pay themselves fees out of the borrowed money quite frequently, and then the company collapses afterwards when they've done a hit and run. And the promise always is that the private equity will find areas of inefficiency and get rid of those and make the company quite functional. I know of one case where that happened, and I'm quite happy to talk about it. It involves my good friend Richard Vague, that we have to have on the show one of these days, because Richard actually did do his own private equity takeover of the bank he was working for at the time, did do exactly what they normally say they're going to do, did turn it around and create quite a profitable business out of it. But the norm is quite frequently asset stripping. And you remember the old movie Pretty Woman?
Mm-hmm, of course, yeah. With Richard Gere.
That was the basis of it.
Yeah.
He was a private equity man.
Yeah.
And what they do is they find an underdeveloped asset. In that case, they was talking about shorefront industrial estate on a river somewhere I think it was in Chicago. I may have got the town wrong. And they then buy it up and sell it for something completely different and shut down the industry. And that's, it may not be intentional in this case of Morrisons that's been the outcome because interest rates caught them a cropper. But this is, asset stripping seems to be the name of the game.
Yeah, absolutely. That was a movie about screwing people over in both senses of the word, wasn't it, really?
Indeed. One being more enjoyable than the other.
I think so. So this is textbook stuff, I think, isn't it, with Morrisons? And they, so they're now at that asset stripping stage in that they have appointed a new CEO, and I'm trying to find his name. Rami Bhatia, I think, is their new boss. He says there's going to need to be big changes to cover the billions of pounds in debt in order to survive. So, but of course, what they're not saying is
the debt didn't exist before the takeover.
So what's happened is, in fact, money that has been given to shareholders. The debt has been created by paying off shareholders, and now the workers are facing cuts because of it. There was a story about one. It was in the Mail Online, which is something I don't normally read, but they've picked up on this story. One employee had a 35-hour week reduced to 12, so her income's basically been reduced by £800 per month because of this debt, which is basically just paying off the shareholders.
Yeah, and a lot of the neoclassical economic theory plays a major role in encouraging this because one of the most famous theorems in economics called the Modigliani-Miller theorem, after the two jerks who came up with it. They got the Nobel Prize, which is why I can informally call them jerks. They argued that it didn't matter how a company was funded, the level of debt had no impact upon the company's valuation. And their logic was that because a shareholder with no debt could buy the shares, or a person, and the company could itself be highly levered, or a person with lots of debt could buy the company shares and the company could be not levered at all, and the outcome is much the same. So it didn't matter how you financed it. And then the next step of their logic was to say that since interest payments are deductible off in profits, whereas dividend payments are not, where there is tax on income, the advisable level of debt for a company was 100%. Now, I probably slightly caricatured the article, but it's a caricature itself, so I'm not going to apologise for that. But what it meant was you had a economic theory arguing in favour of lots of debt, and that was exactly what the finance sector wanted to hear.
Well, exactly. I mean, these companies aren't turning profits, are they? They're making a loss, but they are still managing to make equity payments to the people operating it. And even if they were making a profit, they are making their money by net capital gains on the private equity rather than ordinary income. So they're making, they're getting their money out of capital gains. So the capital gains in the UK peaks at 28%, income tax peaks at 45%. So you can do all sorts of dodgy stuff by evading tax. And that's just the tax that stays in the country. This is a US private equity fund, of course. So, you'd assume that should they be making a profit, and of course they've written off a massive loss against Morrisons. So, Morrisons isn't going to be paying any tax now to the UK government. They're making any profit that is being made by the group as a whole in the United States. But a lot of that will be payments in capital gains rather than in straight income tax.
Yeah, I mean, this is another con job which has happened globally.
It's a minefield.
Yeah, I mean, like Australia did the same thing. You might remember under the Howard government, they halved the rate of capital gains. Now, the idea was it's supposed to lead more investment. What it actually is was more speculation. You're better off to, any income you generated, you're better to disguise that and call it capital gains, and you therefore halve the rate of tax you're paying. So there are so many tax loopholes that have been created in favour of capital gains, ostensibly because that leads to investment, and realistically it led to speculation and the sort of asset stripping we're seeing here.
So I'm sure the company would say, we're doing good work because we are providing a solid return for our clients. So our clients are, their clients are pension funds, insurance companies, sovereign funds, stinking rich people. Almost half of them are in North America. and they could be saying, well, okay, we could be making money for these people by investing in listed assets. I've heard this a few times from people saying listed assets, the stock exchange is becoming a bit risky lately. It's getting overvalued. It's too volatile for these funds. They could be putting money into bonds. Bonds have been very volatile. So, there's a bit of a move now for non-listed assets. So that could mean you buy into a share of a company, of a non-listed company, or you just buy a company completely, which is what obviously these private equity funds are doing. So, I'm sure they would say, well, look, we are buying these companies to make a profit so that we're giving a better return to the people who are on our books, our customers. What's wrong with that if we are getting a better return for them than we would by just buying shares on the share market?
Yeah, to me, one of the problems, apart from the fact that it ends up companies being very heavily levered, whereas before they didn't need to be levered because it was equity holders who provided the capital rather than banks lending the money to the private equity firms that do the buyout. And the argument this is more discipline on the firm to make it behave better. But what you get is, as you said with the case of Morrisons, you had an entire family whose history was retailing, and you get a takeover by people who are, which are derogatorily called bean counters. And my experience with that came actually more from the computer industry than anywhere else. And I have a wonderful meeting with a guy who designed the database program. You might even remember, if you're old enough, DBase 2. Do you remember DBase 2?
Yeah, I do.
Okay, well, Wayne Ratliff wrote DBase 2. And Wayne, I interviewed Wayne when he came out to Australia promoting a new venture called Emerald Bay. And he just hopped off the plane foaming at the mouth about MBAs, which is a code word for people who are venture vulture capitalists taking over a firm, who didn't care about the software being made. They simply wanted to make as much money as possible. And as well as taking over the financial running of the company, they also tried to tell him how to design a database program. And what you had was a company which used to be driven by engineers was now driven by people who were worried about balance sheets. And the innovation went out the window. It was a case of what features can we add. So DBase 2 was partly called DBase 2 because it could handle two databases at once. And you'd flip between the two. I used to code in the damn thing, so I knew it very well. And Wayne wanted to bring in what was known as an entity relationship database structure, which is one of the most sophisticated structures you can have, where you what are called entities, what other people would call database tables, and the relationship was a link between the tables. And in an entity relationship database, the relationships themselves would store data. Now, what that meant was, if you designed a form which was supposed to say companies buying products off your shop, then the relationship of the buying relationship would actually each link would contain effectively the rows in an invoice, and it made for a far more sophisticated data structure. But no, Wayne was told he couldn't do that. He had to just add more tables. So rather than having 2 tables to control, they went to DBase 4, which had 10 tables to control. And speaking as a user, it was simply impossible to keep in your mind which table you had open, which particular do-while loop that table was running inside. So what would have been a highly sophisticated change to a better product was ruined by people who are focused more on the dollars they were earning. And guess what? DBase 10.4, I think it was called, failed in the marketplace. So what you get is you undercut the innovation that enables a company to prosper. And that's because you've lost the link between the owner of the company and knowledge of what the company actually does.
Yeah, exactly. And that is certainly the case with Morrisons. By the way, I love the way you take us off from these angles. Who would have thought, as we started today, that you'd start ranting about database structures? But, I'm glad you did, because you make a point.
I do it regularly.
You do.
Yeah.
So,
I'm designing them these days. Yeah.
This has been an issue lately because in 2021, it was a big year for private equity firms offering to buy public companies. And the reason for that was because many of these private equity bidders that were sitting on large reserves of cash coming out of the pandemic. So their customers had money They wanted to invest. They'd run out of things to invest in. I've heard this a lot lately as well. They wanted to steer clear of conventional instruments like bonds, so they were looking for where else to go. So there was this big market for acquisitions. And when it is nice, so you've got a bit of money coming from your customers, and then you've got this formula. You go, well, okay, we can take the assets. They're good value right now because, a lot of things are undervalued. We're going to be financed 90% by debt. Then it doesn't really matter what you're buying as far as they're concerned. It's you don't need expertise in that area. You can just make it work because the assets are there. You've got the 10%. 90% is going to come from debt. You're going to be able to satisfy shareholders very quickly. Job done.
Yeah, and this is like the whole finance-driven capitalism rather than entrepreneur-driven capitalism, which comes out of this, and this is one reason that I'm obviously think it's a stupid idea for a capitalist economy, and so did Keynes, because there's a wonderful line, I think it's in the paper, called The General Theory of Employment, when he said when the development of an economy is driven by the activities of a casino, the job is likely to be ill done. And this is one case of casino capitalism taking over, when you have people whose everything they know about is numbers. They don't know about engineering. They don't know about aircraft. They don't know about retail. They just know about getting numbers on a balance sheet. And as a result of that, they take the heart and soul out of these companies, when in fact what makes capitalism work is when it's driven by people who understand the heart and the soul of the business they're in and are often in it for the pleasure of the business as much as they are for the money. So it's the whole idea that a ubiquitous bunch of private equity firms can run real businesses better than the people who actually established them in the first place is a load of bollocks.
And I guess they go after, because I'm wondering how often these private equity deals are actually ever beneficial to the company they acquire. I suspect it's a very, very small percentage.
Well, that's why I mentioned Richard's case, and I'm happy to have Richard. I hope you're listening. I'm happy to have a bit of what you told me. Feel free to come along and correct me. But I think what you did is an example of what should happen in these cases, and it worked because you understood the business. Yeah. So let's have a chat about that.
Yeah. So a lot of the time it is just because the finance works. So now, of course, we've had in the past lots of cases of hostile takeovers where the private equity fund has gone directly to the shareholders to make an offer, or they've gone to the shareholders to try and get someone on the board so that the takeover can get through, which is, of course, why private equity funds go after publicly listed companies. If you go to a company, a family-run business, it's not going to work. For example, would they be able to buy into Waitrose and John Lewis, which are run not as a family company, but they run as a cooperative. So supposedly the members are the people working in the business. It would be very hard, I'd imagine, for a private equity fund to buy into that sort of structure, because people wouldn't be interested, because they'd say, well, hang on a second, you want to buy us and make us lose our job? No, thanks.
Indeed, and that's that's why I think it's important to have people running a business who are actually aware of what the business does, rather than just aware of numbers on a balance sheet.
All right. Well, look. How do we change this? Is there regulation? Are there some policy changes that could be introduced that stop this sort of behaviour? We'll explore that a little bit when we come back on the Debunking Economics podcast. Back in a second.
This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
So we are looking at private equity investors, and are they going to destroy Morrisons? Certainly, I'm sure Morrisons will be a lot smaller in a year's time than it was a year ago or a year or two back, and that is because a private equity firm from the United States has bought into them. They've acquired a lot of debt in that purchase, and then they're saying, well, we've got to pay off that debt. The only way we're going to do that is by making the company more efficient, in other words, smaller, and everyone is going to pay the price for that. Nobody wins in a situation like that. So, Steve, I wonder how we avoid this problem. So Lord Sicker, who is Professor of Accounting at the University of Sheffield, last year he asked in the House of Lords what the impact of private equity firms is having on the British economy. His view, he said, was that the typical business model of private equity firms includes high leverage, financial engineering, tax abuse, pension dumping, job losses and asset stripping. And he named firms that he considered to be the victims of this practice, including Debenhams and Toys R Us. I wonder if he's going to be adding Morrisons to that list. But I mean, he's got it in a nutshell there, hasn't he? That is the way they're operating.
He's got it in a nutshell. Okay, let's have a drink with that man one day, because that's exactly what I've seen out of this experience, seeing it happening over the last 50 years in various industries, as observing most of the time. But what you have is people who don't know the business taking over the business, and the only thing they know is dollars, and that's what they make the focus on, and they can make stupid decisions, like the classic of all time, which didn't actually happen by private equity takeover, but it happened as a company which was run by engineers ended up being run by bean counters, was Boeing. And it was with the 737. They had a particular plane which was certified for flying, had been around for quite some time. Airbus came out with a plane they couldn't compete with in the mid-range market. They decided to take a 737 and modify it so that it would compete with the Airbus, but to avoid the need to certify it, they simply added software they didn't tell the pilots about, and we lost 2 or 3 plane loads of people courtesy of that. And what used to be a company which was dominated by engineers who would never in a million years do something as stupid as that for the sheer sake of being matching a competitor and not needing to get certification again. The engineering caliber just declined to literally a deadly level. And that's why I think it's so important that when you have people running a company, it should be people who know something about the industry, not just a blanket load of money-laden leverage speculators who come in and take it over and say they're going to do a better job.
Well, the response to Lord Sicker is a view which is held by the British Private Equity and Venture Capital Association. I want to talk about the title of that organisation in a second, because they seem like two very different things. But they say such transactions can, and that's the operative word, can help to boost UK jobs, increase management efficiency, and support businesses to grow on the world stage. So they can do that. They don't. Perhaps the reason they don't is because...
They would say that, wouldn't they?
Yeah, well, they would say that. But the Private Equity and Venture Capital Association. So private equity I see as, the situation that we're seeing where companies are coming in and buying the supermarket chains and, riddling them with debt. Venture capital is a very different thing, isn't it? It's where you're putting in seed money to help a business grow. So one of them are leeches, one of them is providing opportunity. It's interesting you've got an association that is supposedly covering off both ends.
It goes both ways. I mean, I've read enough about venture capitalists not to have approached venture capitalists for my idea of ravel. And that is because I've seen, had plenty of people warn me who've been involved in entrepreneurial activities that you'll get done by venture capitalists the same way you might by private equity. You get people who really couldn't care about what you're doing. Again, they're looking at the bean counting numbers. They don't care about the concepts you're putting forward, and they try to take, because you're desperate for funds to try to get the thing developed in the first place, they get an inordinate share of the capital, and then if they can then use that to sell you out at some point, they'll do so. So I've been advised by people that very wary of going to a venture capitalist to get funding. So there's a sense in which this is all treated as if the people providing the capital are knowledgeable about everything and dispassionate about what they're doing. Neither are true. You can get some exceptions to that, but the reality in practice is people who don't know the business and therefore don't understand what they're doing when they take it over can make changes which only work by cutting the quality of what they're doing and get away with it until something screws up. And my most recent example, not recent, it's been going for 15 years, but I've been using a program called MathCAD for my mathematical analysis, which I love, and which I actually was, not only did I was in regular touch with the developers, I spoke with them about the software when I visited the States, and there are several variations of the program which go right back to my ideas about it as a person using mathematical tools. They were taken over by a computer-aided design company, which at the time I didn't think would be disastrous, but it has been disastrous. So they couldn't give a brass razoo about the mathematical side of things, and they basically abandoned their entire user base, redesigning it for the use of their user base in computer-aided design. And it was a nightmare, and all the good people I knew left the firm. So what you have is behavior that takes the brains out of a company and then said, we're going to make more money.
Yeah, so the problem then, it seems to be when private equity forms firms want to control the firm. Basically, they want to own the business.
Yeah.
That is very different, isn't it, from private pension? Well, from pension funds, for example, who want to buy equity in businesses that they don't control, and they could do that obviously just by buying shares in that company. But increasingly, some of these pension funds are saying, well, it's just too risky buying shares or not getting the return. We are better off buying in unlisted assets, making investments in unlisted assets, and then potentially that money could be used for growth as well, because they're not buying in and acquiring debt. They are just putting money in for a return. The company has to grow for them to see the return. That is a much better way of using these funds, isn't it?
Yeah, it's more neutral. I mean, again, this intrusive side of private equity is what I'm focusing upon. I'd like to give the example, and I won't give all the details Richard's given me. I don't think I'd be breaking any rules in saying it, but I just want to cover the essential point. Richard did a private equity takeover of his own bank, part of the bank, because he was a bank in Texas, and all Texas banks at that stage were lending to oil drillers. This was the 1980s and the huge boom in oil prices early on, quadrupling of oil prices. Then they all went bust because there were too many rigs. So the banks then started selling off their profitable bits to try to cover the debt for losing their oil rig business. And Richard was running the retail segment, and he said that he knew what was going on. You present as good a face as you possibly can to the board and to the public, and then you try to get what's fixed up behind the scenes so it actually looks like the image you gave. You said, well, he managed to get funding for his takeover. He knew the business. He knew where the good bits were. He knew where the parts were he wanted to trim. Did it like crazy and turned it into a highly profitable venture, rather than ending up with the asset stripping that happens when people who don't know the business are the ones who take it over. So again, it's this. We talk about capitalism like it's an abstract thing you can write on a whiteboard. It's an incredibly complex system of production, distribution, exchange, and relative powers. And there are so many specialized areas of knowledge we have that if you take over a business and don't have that specialized knowledge, you're going to stuff it up. And the only time these things work is when somebody who's knowledgeable about the business, as Richard was about banking, do the takeover. And most venture capitalists and private equity firms don't have that knowledge, don't care, and they're out for the short-term capital gain, and then ends up screwing up capitalism rather than improving
Clayton, Dubilier and Rice, the company that bought Morrisons, I mean, they have a vast portfolio across a whole load of different industries. So they are just doing the numbers. They're not a specialty business in any way. You'd assume it would be nice if their companies grew, but if they are, in each case, giving those businesses the debt that they used to acquire them, they're not going to grow out of that situation, are they?
Most of them don't. And they're not most of them. If numbers survive, but I think it strips the personality out of those businesses. And often what makes them succeed as businesses in the first place is the personality they acquire through an owner who actually knows the business and is trying to develop it and improve it over time. So it's normally a bad sign when your firm gets taken over by private equity. Nobody clicks their heels and cheers. What you cheer is the prospect that you won't go bankrupt. There certainly a lot of firms do end up in doldrums, and you have technological development that means that what was a hot area becomes a cold one over time. Like Polaroid's a classic example of that. They actually, from what I understand, they actually developed almost the very first digital camera, and they decided not to pursue it because they made too much money out of the disposables, and that's what brought them undone. So sometimes with change of technology and existing management can stuff up, and yes, you would do better if a new management took over. But most of the time you have people who don't know what they're talking about taking over a business, and the only way they succeed is by paying the workers less, stripping out the assets, and trying to sell the thing on a rising finance market. And you're not developing the company, you're disemboweling it.
Well, and the reason they're doing that, of course, is because they are in it for the equity, aren't they? So they buy a business, say for $10 billion. They want to see it suddenly being worth $12 billion, and they only paid $9 for it. So they've made a gain. So that's a capital gain. and they get taxed as a capital gain. So in the UK, that's 28%. Income tax peaks at 45%.
Yeah.
So so it's a very efficient way of making money and paying less tax. So the way around that, which in the US they're looking at this to try and moderate the behavior of private equity firms, is actually saying, well, I'll tell you what, for these companies, for private equity funds, we're going to tax it all as an income tax. So all of a sudden that incentive disappears.
Yeah, and that's
you've got actually got to operate a business that's making a profit,
and that's much more sensible, because again, it's this focus on capital gain. It's casino world. It's not running a business, not getting an income stream over time, and this is one of the classic things that pro market junkies like to so call as a distortion, and yet there are they get rid of distortions like trade unions. They're not willing to get rid of distortion like having a greater capital gains tax that's half your income tax level, because that benefits people in their social circle and them most of the time. Look at all the MPs who are household earners and don't pay tax on the income gain on their first home and or their portfolio of investment properties. So what you get is a focus on speculation rather than investment, on numbers rather than the rich tapestry of a capitalist production economy, and that ends up destroying the damn thing over time. And it certainly doesn't make anybody who works for those firms happier.
Yeah, exactly. Well, it would be nice, wouldn't it, if you could turn the tide so that private equity firms have less of an incentive just to speculate, so that they use the money, maybe not, like pension funds do, maybe not to acquire firms, but just to invest in them for growth, rather than just investing in them to try and build up that equity by asset stripping. So the other thing they're looking at in the US is higher priority to employee compensation if the company was to go bankrupt, because I'm sure there's a bit of a game played there as well, and prohibiting the payment of dividends for 2 years after an asset's been acquired by a private equity fund as well. So they can't try and strip out money and pay themselves healthy dividends immediately afterwards. I'm sure there's many more things that can be done, but it certainly needs to be looked at because it keeps on happening, doesn't it? And for the UK, I mean, we lose out. So we lost control of a family business, a successful family business that was doing a great service for people, primarily in the north of England, giving them what was a pretty good, it still is actually, frankly, but we'll see what happens over the next few years. But quite a innovative supermarket chain with a bit of history behind it might go to the wall, or certainly will not be a shadow of its former self as a result of all of this, and the UK government losing out on all the taxation from profits from that business, and lots of people losing their jobs. No one wins in this.
No one wins, and maybe even the private equity go under because they took on. Well, the thing is, they take on debt and then package that out so they don't go down with it. But it'd be good to see some of them go down with the ship they sank occasionally.
Yeah. Meanwhile, all those people who had invested in Morrisons, who were shareholders, all of a sudden now have got extra cash, wondering what they do with it. They probably go to their local private equity fund saying, what can you do with this money?
Or back onto the stock market. Just what we need, more stock market bubbles.
Exactly. Yeah. Nobody wins. All right, very good. Good to talk, Steve. We'll catch you again next week. Thanks.
Okay, mate. Bye.
The Debunking Economics Podcast.
If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.